Good morning. Day 2, Chapter 2. Apology on the front end. Some of the material today doesn't follow the chapter very closely. I think from tomorrow on, the material on the lectures will more closely follow the chapter. But today we're going to talk about some material that's not in the book that I think is really important. This first slide is not an example of that. The first slide's right out of the book, and the whole purpose for showing this slide is to emphasize these are very large organizations. When you think of $9 billion, $13 billion, $15, $18 billion in revenue from companies whose only product is people's time. General Motors has cars, retailers have product to sell. Accounting firms only sell time. So these are huge organizations. You can kind of see that by the number of professionals they employ. I want to also emphasize that Deloitte, you can see, has the highest percentage of consulting work and the lowest percentage of audit and tax work. And the reason was some years ago, probably 15 or 20 years ago, the SEC encouraged all the accounting firms to spin off their consulting groups. Pricewaterhouse sold most of their consulting group to IBM. Ernst & Young sold their consulting group to Capgemini. KPMG spun their consulting group off to Bearing Point. So they were more comparable in size before the spinoff. Deloitte was in the process of spinning off their consulting group, and the market collapsed, and so they never did. So that's why Deloitte has the biggest consulting practice. You can see that the other firms are obviously getting back into the consulting business. But these are huge firms. The other thing I want to point out is the Big Four are excellent firms. They're excellent employers, period, end of report. But they're not the only excellent accounting firms out there. So some of the regional and local accounting firms around are very, very good. The difference is all four of the Big Four are excellent. When you get down to smaller firms, you have to do more homework to research how good they are. We're going to look at Burr Pilger Mayer. That's a firm on the peninsula, and we've got a couple partners, or one I know of, I think 2 partners of BPM. BPM is an excellent firm. And like I said, we have lots of other really good local and regional firms that recruit at Cal Poly. So we're very fortunate not only to have the Big Four recruit at Cal Poly and some of the second-tier firms, but also some of the local and regional firms that recruit at Cal Poly are excellent. The objectives. So these are the thou shalt memorize: 200, 315, 500, 700, and independence. So when Tad says, how well should you know them? Virtually word for word. And we'll go over that. Hopefully you'll see by the end of the quarter that, there was a reason he stressed these. 200, they all start out the objectives of the auditor. So the overall objective of the independent auditor and conduct of an audit is, and then the first sentence is the overall objective of the auditor is blah, blah, blah. Obtain a reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are presented fairly in all material respects. But that's a thou shalt know. Now, reasonable assurance and material misstatement are highlighted because they keep coming up and coming up. But I really want you to know, at least the part in red, word for word. Now, another thing is Obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error. Every time I see the word material misstatement, I'm going to add whether due to fraud or error. That's not right 100% of the time, but it's almost always right. Tad's never right 100% of the time, but what we're trying to focus on are those things that are right almost all the time. 315, understanding the entity and its environment and assessing the risk of material misstatement. Okay. I can't tell you how important I think this is. The objective of the auditor, they all start with the objective of the auditor. Identify and assess the risk of material misstatement, whether due to fraud or error. It's a financial statement and relevant assertion level. How do I do that? Through understanding the entity and its environment, including the entity's internal control. Okay. Why do I do that? To provide a basis for designing and implementing responses to the assessed risk of material misstatement back in sentence 1. So to me, I don't have a great memory like you, so I'm going to say, what are the 4 key elements of this? What are the important things? Identify and assess the risk of material misstatement. I do that at the financial statement and the relevant assertion level, because the financial statements are too big for me to get my arms around. So I'm going to focus on the relevant assertions. How do I do that? Through understanding the entity, its environment, and its internal controls. Okay. Why? To provide a basis for designing and implementing responses to the assessed risk of material misstatement. 500, audit evidence. The objective of the auditor is. Okay, so again, I'm going to break it down into pieces. It's too big for me in my old mind. Plus, I'm trying to figure out what's important. Okay, so rather than memorize what's important, you memorize it the night before the test, but while you're studying these, think about the pieces and what's important. To evaluate information to be used as audit evidence. Previously, we talked about audit evidence as information that's been subjected to audit procedures. To inform the auditor's conclusion about whether sufficient appropriate evidence has been obtained. Okay, so we can't express an opinion unless we've obtained sufficient appropriate evidence. So the objective of the auditor is to evaluate information to be used as audit evidence, the results of audit procedures, to inform the auditor's overall conclusion whether they have sufficient appropriate evidence to express an opinion. So, think about what the pieces mean, and then memorize them the night before the test if you want to get the highest grade. That's okay. 700, forming an opinion and reporting on the financial, the objective of the auditor. Form an opinion on the financial statements based on evaluation of the audit evidence obtained. Express that opinion in a written report that also describes the basis for opinion. So to me, there's 2 pieces to this. Form an opinion on the financial statements based on an evaluation of the audit evidence. Express that opinion in a written report that also includes a basis for that opinion, an explanation of how you reached that opinion. Independence. Okay, the first 4 are audit objectives. This is just a definition. A member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. A member in public practice should be independent in fact and appearance when providing professional auditing or attestation services. Member, we talked about, is a member of the AICPA. So all members of the AICPA, if you're a member of the AICPA, you should maintain your objectivity and be free of conflicts of interest in discharging professional responsibilities. My daughter, Lindsay, is a tax accountant. I know it puts a stain on the family name that she went into tax instead of audit, but I still love her. Patty makes me still love her. The first sentence applies to Lindsay, the tax accountant. A member in public practice should be independent in fact and appearance when providing professional auditing or attestation services. So the second sentence only applies to auditors. Now, we'll leave it at that for now. So that's why this is really the definition of objectivity and independence, but I teach it as a definition of independence because I want to stress, the rule doesn't apply for all members of the ASCPA. Independence doesn't apply. Independence only applies to those people that are doing auditing or attestation. We believe independence makes it easier for the auditor to do their job. If the auditor is independent, it's easier to act with integrity, to be objective, to be skeptical. Ooh, there's another important word, professional skepticism. Okay. Independence includes independence in fact and independence in appearance. Okay. And I don't care whether you say independence in fact or independence in mind. We used to say independence in mind. Now they say independence in fact. Now, that really bothered me when I was a student. If I'm independent in fact, what difference does it make if I'm independent in appearance? Well, think about it. The investors can't get inside your head. Investors don't know whether you're truly independent or not. They don't know. So investors rely on the appearance of independence. So the appearance of independence is very important because that's all the investor has access to. The investor can't get inside your head and see if you really are independent or not. So the appearance of independence is critical. LLC, limited liability company, are taxed like a general partnership. What's that mean? That means the LLC does not pay income tax. The profits flow through to the members of the LLC who are responsible for paying the income tax. It limits the owner's personal liability similar to a corporation. Remember, we're talking about limiting the owner's liability, not the corporation. So the LLC is similar to a corporation in the fact that the LLC is liable, but the owners are not liable. Make sure you get that difference clear. So corporations, we talk about limited liability related to corporations, but the corporation still has unlimited liability. It's the owners of the corporation who enjoy limited liability. Similarly with an LLC, or on the next slide, an LLP. With an LLP, the owners enjoy limited liability, at least some of them. So an LLP, so all the big accounting firms are LLPs. They're taxed like a general partnership. The LLP does not pay income tax. Okay. The profits flow through to the partners, and the partners are liable for the income tax. So if you're a partner in an LLP, you pay income tax on your share of the LLP's profit. There's no double taxation. Okay. But you as a partner receive your share of the profits and pay tax on your share of the profits. Partners are personally liable for the partnership's debts and obligations. So what that's saying is the LLP is still liable for its debts and obligations. So we don't get out of the debt and obligation. Partners are personally liable for their own acts and the acts of those under their supervision. Partners are not personally liable for liabilities arising from negligent acts of other partners and employees not under their supervision. Okay. So if a partner does something wrong and somebody sues the partnership, then the partnership is still liable. But they can't come after the individual partner's assets except for the partner who was responsible for that audit engagement or whatever type of engagement it was. Is that clear? The LLP is still liable. If somebody sues the partnership, the LLP is still liable. But if the LLP doesn't have enough, so let's say the LLP has $10 million of assets and they lose a $25 million lawsuit. The LLP can't cover the entire loss. Now, the partner who was responsible for the acts that caused the problem, he has unlimited liability. But the other partners are not liable. So the other partner's personal assets, the savings accounts of a partner, are not at risk unless that partner was the partner responsible for the engagement. Think that through. I know you're saying if you did a good job explaining it, wouldn't be so hard to think through. Important organizations, the SEC, the PCAOB, Financial Accounting Standards Board, State Board of Accountancy, AICPA, and the California Society of CPAs. Okay, so the SEC was created by Congress, Securities Exchange Commission. It has the authority of Congress behind it, and it interprets the laws passed by Congress and creates regulations. It's similar in a way to the IRS. So the IRS doesn't create laws, Congress creates law, and the IRS interprets it and creates regulations to try and implement those laws. Similarly, the SEC. The SEC doesn't create law, but it enforces the laws created by Congress. The PCAOB was created by the Sarbanes-Oxley Act, Public Companies Accounting Oversight Board. Okay. And it was created by Congress. Congress told the SEC to create an agency, and it turned out to be called the PCAOB, to regulate auditing of public companies. Okay. Now we got the FASB, the FASB. The FASB is kind of a non-governmental agency. It wasn't created by Congress or by law. It existed before. The SEC has always supported the FASB and said they do a good job of creating accounting principles. But now the FASB is funded by fees collected by the SEC. So it's becoming more and more closely attached to the government. The AICPA is a club, a good club. Right? But certified public accountants belong to the AICPA. The California Board of Accountancy is a government agency. We always make fun of the California Board of Accountancy, but in reality, it's very important. I can't practice accounting in California. I never transferred my license from Arizona to California. So the California Board of Accountancy actually holds your license to practice. If you get suspended by them, you can't practice accounting. We just kind of saw that in New York with Giuliani, and the equivalent board for lawyers said, "Oop, you can't practice law in New York right now." GAAP, General Accepted Accounting. Don't get GAAP and GAS backwards. It's going to be a long quarter if you get them backwards. General Accepted Accounting Principles. The FASB is the primary source. The SEC has the legal authority to create accounting principles, but it has delegated that responsibility to the FASB and pretty much lets the FASB create general accepted accounting principles. General accepted auditing standards. The PCAOB creates auditing standards for public companies. The AICPA creates auditing standards for private companies. Most of what we're going to talk about this quarter will be private companies, AICPA. My reason for choosing that is twofold. Years ago, I had the privilege of teaching audit fundamentals for KPMG, and they taught private company first and said people need to learn one or the other first, and then it's pretty easy to add on the second. So their thinking was, if you learn the auditing standards for private companies, and then you go back and learn the auditing companies standards that may be different for public companies, that will be easier than trying to learn them both at once. So I really like that. I chose AICPA first because if you take the CPA exam, it is written by the AICPA. The AICPA does have questions related to public companies, but I think they have a bias toward their own standards. Just my thoughts. Okay. So 90% of what we're going to cover this quarter is for private companies. Not to get overly concerned. Most everything that you learn that relates to private companies is very similar to the auditing standard for public companies. In fact, when the PCAOB was formed, its first auditing standard was to say, let's take all those auditing standards previously created by the AICPA and adopt them, and then we will begin changing them over time. So there's just a lot of similarity and overlap. GAAP, general accepted accounting principles, come from the FASB. The FASB issues, when they issue a new standard or a change, it's called an accounting standard update, and it goes into the accounting standard codification. And that's the 310, 1025 3s, how they're indexed. We'll talk about that in a minute. Auditing standards, we've got big and small. For public companies, the PCAOB issues auditing standards. For private companies, the AICPA issues statements on auditing standards. So if you see an AS, that's a public company. If it's an SAS, it's a private company. We're going to spend our time on the right-hand column here. The accounting standard codification, the way it's indexed, the 310 is the topic. The 10 is a subtopic. The 25 is the section of the subtopic. And the 3 would be a subsection of the section. So in this case, it's receivables, the overall subtopic. 25 is the section on recognition of receivables. That actually relates to what we're going to cover this quarter a lot. So think about the role of auditors in capital markets. Think about what your role is. So we've got stockholders who elect a board of directors. It's not a democratic election, but the board of directors are there to represent the stockholders. The board of directors hire management, so at least top management, the CEO. So companies theoretically, CEO answers to the board of directors, who answers to the stockholders. Okay. The board of directors has a committee, an audit committee, who hires the auditors. But I want you to think of our role in the capital markets. So we try to add credibility to the financial reports issued by companies. How do we add value? Can we, is the opinion of the auditor so valued that it's worth paying the auditor that money, and people will pay a higher price for the company's stock? So we fit into the capital markets. We're a critical part of making the capital markets efficient. Efficient capital markets, that stock should reflect as close as possible the value of the company. If investors are skeptical about the information in financial statements, they will pay less and less and less for the stock. We want, in efficient markets, we want that stock to sell as close as possible to the actual underlying value of the company. Auditors play a role in making the markets more efficient. Okay, so here it is. Got the board of directors is elected by the stockholders. The stockholders, or the board of directors, hires the CEO, and the board of directors is run by committees. We may have a management committee, we may have a strategic committee, we have a compensation committee, we've got an audit committee. All public companies are required to have an audit committee. The audit committee hires the independent auditor. Private companies may or may not have an audit committee, but all public companies are required to have an audit committee. And the independent auditor answers to the audit committee. Quality control. All I want, you don't have to know on this slide, all I want you to know is the AICPA issues standards on how to run your audit practice effectively. So we've got leadership responsibility, ethical responsibility, clients, engagement performance, review, monitoring. So you don't have to know any of that. I just want you to be aware that there are the AICPA issues guidance on how to run your audit practice well. Tomorrow we're going to introduce the basic standard audit report. Thank you and have a good day. I'll see you tomorrow.